Welcome to the new year, 2023. Hope it's better than the minus 19% we saw last year. I'm Lex. This is Options Brew TV, Traders Workshop, and we're going to get right into it. Good morning, gents. Welcome to 2023. How are you guys? Mark, Jason, what's going on?
I'm doing good there, Lex. How are you? Did you have a good New Year?
I did. I started something new in January, first time ever. Everyone does this, dry January. I call it for myself semi-dry January. I'm trying to avoid Monday through Thursday of having a nice glass of tasty wine or any other beverage, and then pushing it into Friday, Saturday, Sunday, so that I get into this binge mechanism. So I'm not sure which is better. I find I have a lot of stress on Monday, Tuesday, Wednesday. It's a sign of a true, probably someone who drinks too much. But yeah, that's what I'm trying. How about you guys?
That's good. I look forward to an update come on January 12th, January 20th, and seeing how this is coming along for you. I tried it and I've done miserably at it.
Yeah, it's going great this week. It's only Thursday, and I started on Tuesday because Monday is official holiday, even though it was January 1st. So I didn't do it Monday. So Tuesday, Wednesday have been okay. I find I get a lot of stress about 7 o'clock in the evening. And then I have to watch like Yellowstone, binge watch Yellowstone, and it kind of goes away. Although everyone in Yellowstone's always having a whiskey, sitting around having a whiskey at any time of the day. So anywho.
So can I tempt you with like a nice burgundy? Should I wave this in front of you?
That looks so good. That's the thing I miss the most is a nice glass of red wine with my fava beans. No, it's it's tough. I'm gonna try it.
I don't have any Chianti here.
Yes. All right, let's get into it. Markets, yeah, I kind of forgot the Dow's already down 283 points. Nasdaq down 119. S&P's down 38-ish. So, Jason, give us a little update on with Volland on where we sit. What's it look like above and below? Are you an SPX?
Yeah, I'm an SPX. Are you sharing the window?
Yeah, I am. Go ahead.
All right. So in SPX, I'm going to start with Vanna this time because there's not a lot of delta in here, only 20 million around where the money is. But Vanna has kind of been showing the story. This strike right here, this 3,700 negative Vanna, and this negative Vanna here at 4,000. Negative Vanna tends to repel as far as dealers are concerned because implied volatility is going in the opposite direction of delta. So it's as if you're short an option. And they have to, if implied volatility is going down and delta is going up, they have to sell. So it kind of pushes away what that normal correlation is between volatility and SPX movement. So if you come into Volland and you see these negative Vanna strikes, they kind of repel. Most people talk about Vanna pins because they're positive Vanna strikes that attract because the implied volatility and the SPX movement are working in conjunction with the dealers.
Okay.
However, in January, we've seen this 3,700 and this 4,000 just bounce us back and forth. It hasn't been a pin at all. It's been more like a pong. Ooh, I'm going to write that one down. I'm going to put that in Twitter all the time now. We're not pin, we're pong.
Okay.
So we're ponging and Vanna is effective between around 20 and 40 delta. So it's giving us this range in SPX. I guess it would be about like 37.75 and 38.75, and we're just bouncing back and forth, seemingly hitting both strikes every day. So,
right. Okay. So it looks like the magnitude of those lines is not large. Is that accurate or not?
Well, if you only narrow it down to January, because these big lines over here are in the March monthly expiration.
Okay.
And this one is also January here, but there's a larger one at 4,300 over here.
Okay. Got it.
That's also negative. So basically, if in January, the Vanna is going to grow faster because Vanna increases as you get closer to expiration. So pretty much what I would expect for the rest of January CPI numbers notwithstanding, is kind of a widening of this range that we're in, but still playing Vanapong until expiration.
So what? Yeah. So the thing that gets us out of the Vanapong, this range, let's say, I guess the obvious thing is some sort of news event, right? A macro news event.
Yes.
So that's number one. Anything? I mean, any normal kind of occurrence, all of a sudden people feel bullish and they say, let's go get on the bull train.
Honestly, I think the one thing that can get us out is option expiration.
Really?
Because then they fall off, and then you're stuck with a different Greek
right
kind of surface for the
sure,
dealers.
But people will roll, right, and re-hedge. Is that right? Most likely.
Typically what's been happening is there hasn't been so much rolling. There has been re-hedging into February, but those Vanna strikes will not take into effect for like another week or two. Okay. But right now it's getting stronger and stronger the longer we wait. And unless, maybe non-farm payrolls tomorrow can get us out of this range. And if it does get us out of the range, you can see acceleration one way or the other, depending on where you go. So if we sell off today and then sell off tomorrow past that 3,700 strike, we can be going pretty far, pretty quickly, actually.
Yeah. Okay. All right. Makes sense.
Yeah, I'm just looking at the chart since last expiration, and I mean, like, those literally are the highs and lows of the channel, right? That 38.75 and 37.75 since December expiration. Today's price action is interesting, though, because futures were up for a good amount all morning, right? Being over here, I have the benefit of being able to watch them all day or all night for you. But we were up 20 plus points at one point, and all this selling hit as soon as the SPX opened. I mean, we like gapped down futures versus SPX by a decent amount and then just kept selling, which to me doesn't sing dealer hedging on the open. That can
actually, I think
maintain it, but yeah.
I think the ADP employment report came out and it came out hot. So I think that might have been like a catalyst, like a non-normal catalyst. It was like kind of foreshadowing what tomorrow may bring. But if you looked yesterday's JOLTS data and there was the ISM manufacturing employment data, they both came in hot as well. Even though manufacturing was down, manufacturing employment went up. So I can it's foreshadowing a hot number for non-farm payroll tomorrow. And so it'll depend on wages, I think, whether tomorrow is a positive or negative catalyst.
So when you say, just so the viewers understand, when you say hot, that's going to imply that the Fed still has to behave with the interest rate part of the equation. Is that right?
Yeah, well, so when I say hot, I mean it's higher than expected. Yep. And if it is higher than expected, I think yesterday's Fed minutes have kind of made as obvious as possible that they are not excited to see high asset prices into this kind of environment. So they are going to be resolved in, deflating the equity markets. And I think it's kind of becoming internalized as some of the data comes out that gives them runway in order to be more resolute in there.
Right. So where does it all kind of bottom out relative to this balance of inflation and trying to control that? I mean, at some point, it's got to be a market problem instead of a government problem, right?
Yeah. So one thing that I've been saying on Twitter a lot, I do have economics background, and I kind of like to look at currencies and how central banks are interacting. And the one thing that pops out to me is the European Union has started tightening hard. Britain has started tightening hard. Obviously, America is tightening. But you have Japan, who is still easing. And last month, Japan kind of blinked just a little bit by increasing their yield curve control range on their 10-year bond, and markets really spit up. And I think what's happening is markets are staying somewhat stable because those kind of carry traders are able to borrow in the yen super cheap still, and buy treasuries elsewhere, anywhere now at this point.
Right.
If the yen starts getting expensive, we can see probably a crashy kind of feel. And there's been speculation that might start happening in the first quarter of this year.
Okay. Doesn't sound like any fun to me, quite honestly. I think people are generally happier when they're having a glass of wine during the week and when the market's going up.
Yeah, I mean, you can't short in your 401k, right?
Right. What, Mark? What did you say? Sorry.
I said just 2 or 3 basis points. I don't need a lot. Just make it green.
That's right. I know. I'm so much happier when I see green. I don't know. I just feel like it's for us in the pro world. Green or red didn't really matter. Probably red was better for us because volatility kind of poked its head up, and that was always interesting. And pricing got sort of not mispriced, but it got chaotic, which is good. So as long as there was volume in those down markets, we tended to do pretty well. But I think now that I'm wearing my retail hat, of late, I think it seems like the retail folks, generally like the green side of the equation. They're mostly long portfolios and what have you. I actually did a show yesterday and met a couple guys who have a hedge fund, and their hedge fund is buying tail risk. Okay. So they manage tail risk, and they do it with, a pretty sophisticated look at implied volatility, and they come up with cheap 4 and 5 sigma sort of puts out there that they used for the catastrophes, and they've been pretty successful because they have a strategy on the backside that manages the bleed of having those puts. Pretty interesting. So some of that stuff's popping up as well. But anyhow, the market is now down 400 points. So as we're speaking, it's moved its way down, but SPOOs are at 3,800. So we're still in that middle zone of 37.75, 38.75.
Yeah, like I said, it seems like we hit both strikes every day.
Yeah, it's amazing. I know. Mark, let me ask you a question. End of year sort of gymnastics for either retail or pro folks. I know December 31st, there's some big things that go on. And we were talking in the pre-show about where things get marked, and no pun on your name, but where things get marked. So can you give us a little rundown on your thoughts relative to that?
Yeah, for sure. I just think it's an interesting time of year to talk about that, right? Like towards the end of or through December, we're all tracking how far all various asset prices were down. And now it's like, okay, 2022 was the worst year since the great financial crisis. Yeah. Everyone in their PA is thinking about what valuations look like. And we're starting from a clean slate. You're starting with fresh P&L, sort of. You're still wearing whatever bags you had last year that you didn't tax sell. But the idea of marks and options is really important because unlike equities, for example, equity, we know generally what Apple should be worth. Sure. Is it moving around? Is its discounted cash flow out 20 years moving around 1 or 2% every day? No, but that's a pretty liquid single asset market compared to the multiple thousands. And, I think there are over 1 million options strikes in total, several thousand per issue. Even in the SPX, SPY, you have some illiquid spots in there and the deep in the monies and out of the monies. So how that gets valued is interesting, right? And especially in the illiquid stuff, you can push it around a little bit to the extent that, you're willing to tighten a market or put it closer to what you think fair value is, because ultimately a mark is just that. It's just it's a split between the bid and the ask price. It's not giving any indication. That's what the market midpoint is, but that's not like really what fair value of that is. So, as we look at those marks and base our sort of future valuations off that, be wary of how those can get pushed around and what the fluctuations are, and that like your P&L favorably or unfavorably isn't always what your mark says at any given point.
Yeah. So what's the protocol in the industry now? I think in our day, marks were always midpoint market. Is that right? Is that how the clearing firms decided your end of day P&L? I think that's it, right?
Yeah.
Yep. And for the vast majority, like that's always going to be the case. I think in very rare instances, at the end of the trading year, you'd always have someone say, hey, that should be worth that, or that should be worth that, because I'm doing extra, X dollars of comp if that gets marked a nickel this way or that way.
Yep.
vast majority of situations, you don't adjust, right? Because if they're correct, well, the money should come in next year. And if the money doesn't come in next year because they lost it, well, you would rather not pay them the first year. So,
Right.
but, or it's wrong and the market, Mr. Market truly is right. So very rarely does I think it make any sense for a clearing firm, a trading firm, the OCC to adjust those marks.
Yeah. Yeah. See, I think I don't want to get anyone in trouble, but marks at the end of the year affect your tax bill. Right. And what I mean by that is in the professional space, like, you know, Mark, you and I lived, whatever that closing value was affected your tax bill for that previous year. Right. So that's what you paid your taxes on.
Which was a big
I thought you pay your taxes on realized.
No, we paid on what the value of our accounts was by the end of the year, and that equated to P&L whether it was realized or not. Isn't that right, Mark?
That's correct. This
was for market makers.
It's a special, condition for market makers, because otherwise, what market makers were doing in the early '80s, and when options were first invented, was you could permanently, and the same thing happened in futures, right? It isn't exclusively an options problem, but any type of the derivative security, you could permanently roll profits forward and never have to take them if you could find the right trade with an offsetting counterparty. So market makers and futures dealers were all required starting in '86 with the Bradley tax reform to mark to market at year end. And in exchange for that, they got the 60/40 treatment. And that's where the mixed straddle, the 1256 provision comes from, of marking long-term and short-term, because it was, Gucci Gulch that was trading back and forth on, how that bill was going to get handled. And so the concession to the industry was the 60/40 treatment in exchange for marking it every year.
Yeah, it was, there was some shenanigans here and there, but we won't talk about that. So
the only adjustment, as we were talking, I just remembered, if you have far downside puts or calls, like if the 250 call is 0 at a nickel and then the 280 call is 0 at a quarter because it's illiquid, they'll mark the 280 0 at a nickel. That's like one of the few automated sort of remarkings that'll happen.
And that's newer, right? That didn't happen back at least back when I was on the floor. That didn't happen.
Oh, you had to call Merrill and say, hey, where are you marking these 280s? Hey, can we get our money back?
Yeah, I find that I get a lot of questions on where things are marked in our platform at Tradie or TradeHawk. We give the end user the choice of where he can evaluate cost or value, I should say. It isn't theoretical value; it's where things are being marked. So you can either mark it at midpoint, which I always recommend. You could mark it at last trade, which I never recommend. Or you can mark it at what we call a market value. What that means is that when you're long an option, you mark it on the bid price. When you're short an option, you mark it on the ask price or offer, right? So some retail firms do what I just said, the market price. I don't think many though do midpoint in terms of how they mark the portfolio. Some probably do, but we do it one of three ways. And I never advise on last trade, because what's the risk of last trade for a retail person? It's an illiquid option that traded 3 weeks ago, and the last price was 17, and it's trading $5 at 550. Well, 17 is irrelevant to $5 at 550, right? So you get it down to midpoint or somewhere thereabouts, and get a feel for where you are, right?
I think a closely related concept to marks are edge, right? Like if you have positive edge, that would be your value is, if you're long the option, your value is higher than where it's marking. You think that the market is off by X, that's why you're buying low and selling high. That's your edge. So comparing your value to the market's value, or to the mark value, I should say, is sort of your edge. And as market makers, we used to think about edge as having a certain half-life and probably only a day or two. Like if you consistently think you have edge in something and the market is not repriced, you don't have edge in that thing. And edge isn't a permanent phenomenon. Day one, sure, we can count that dollar of edge. Day two, probably only worth 50 cents. By day 3 or 4, move your inputs, buddy. That's not worth what you think it is.
Yep. Yeah, that's a good point. And I like to kind of address that next show. Is it leads into synthetics, okay, which we don't have time to talk about today. But the one way you can realize that edge is to convert, box it off. Now, there are risks, and we'll talk about what the risks are next time. Interest rate, dividend, pin risk, all those exist. But I was trying to explain to a group of retail folks that I can buy a put and buy stock, which is a long call, right? And then I go sell that same call and buy stock, which is a short put, and I can kind of hedge that off. And I'm getting edge on both sides at different points of the equation, assuming it hasn't changed that much volatility. I can essentially lock that in. Okay, there's a way to lock that edge in, and the edge does become real. You get it at expiration at some point, unless the events I just said, interest rates change or dividends change. But you can do this in short-term things as market makers. You can't really do it as retail people, but that's what we're looking at. So we'll talk about those synthetics maybe next time. Real quick, we have a question for Jason, I believe. Tail risk trading, how can that be seen using Volund? So I brought up tail risk from the gentleman who did the show the other day. Is there a way you can? I think I know the answer, but I'll let you answer. What in Volund, does it show something like that, or is that more like a kind of a gamma cluster sort of event?
No. So hold on. I got to share my screen again.
Yep. Hold on. I got it. I'll get you. Go ahead. Oh, you're not doing it. I see.
Yeah, I turned it off.
Don't ever turn off the screen share. All right. There you are.
Okay. So first of all, do you know what the underlying was that they were doing their tail risk things on?
Well, so what they do is they actually manage it by individual equity, but they use a macro index to manage the tail risk. So that would be SPX, QQQ, Russell, and the like. So they would use that sort of product to manage even the basket of equities that most resemble the index.
Yeah. So, all right. So this is kind of depending on what you want to see in, what the strategy is and what tools they are using, options, futures, whatever. Mm-hmm. Typically, when you look in the Delta Greek, you will find these large bars way out of the money that you don't, and this is a good example right here. There's something down here at, 2000 that somebody probably bought a bunch of puts and left dealers short puts down here at 2000. You won't see it in any other like second order Greek like Gamma or anything because that's too far out of the money. That's very small consequence. Even here, you see 3,200. You see like this massive delta spike. It's probably somebody's buying puts down here, way out of the money.
But let me interrupt, Jason. That someone could be an institution like this group. So they're not market makers. That could be them. That's their tail risk hedge right there, potentially.
Yes, potentially. Okay. And that's, and you also have up here these negative delta areas where it's like here at 4,700, you have probably a bunch of long calls. So they're doing the right tail up here. Yep. So this is typically where I see like tail risk kind of things. And I do pay attention to it a little bit.
Okay.
But yeah, you won't see it necessarily even in Gamma, because if you look in Gamma, this far out of the money, you're not going to see any kind, the market could go down to 3,000. And if you have a 1,000 put expiring in January, it's still not going to be affected. So you kind of have to look at it in the delta screen rather than any other kind of second order.
Makes sense. Okay.
Well, and tail risk strategies these days tend to be pretty complex, right? People aren't just buying puts, that they're managing a structure. And to your point, Lex, and I can't wait to see the show, but like they're managing that theta cost, right? Because like buying at the money put on the SPX, it costs something like 10% of the premium right now. Even if you go a little out of the money, like you have the problem Jason described, where you're just long a put and maybe that doesn't hit. So like, I think it's a real blended strategy of long and short data management, 1x3 type structures, 2x5s, that like, it doesn't look like just a standard spread, that it's a much more dynamic. So the things that are popping up on Volund are probably just one leg of a much bigger strategy.
Yeah, absolutely. I actually think a lot of it is boxes too, because if you have like some kind of way out of the money put call box, you're getting, you're probably realizing only one of those legs in delta. So it's kind of, it's very difficult to kind of see that, but you get an idea when you see it in the delta section.
Okay. Good.
Sometimes also it's I kind of flipped over here to VIX, and you don't really see anything here, but in the delta section of VIX, you can see some, here in 42.5, or you can see some of these bars get a little long, but
yeah. What real quick, what's your feeling? VIX, you mentioned that. So the guys yesterday were were indicating that despite the the larger down move in the market, in general, VIX has remained fairly cheaply priced.
Mm-hmm.
And that in their opinion, their tail risk is cheap to own. And I don't want to put words in their mouth, but I'm sort of paraphrasing. And I think that's true. You don't see massive VIX spikes with these moves. It doesn't seem like, right?
Well, that's
VIX
true.
And cheap, but VIX calls as a tail hedge did not work at all in 2022.
No, you're right.
VIX topped out at like 35 or something like incredibly low like that. Whereas any of the previous sort of meltdowns like this we've seen, we're getting numbers in the 50s.
Yeah. Yep.
Exactly. And also skew has been, though, pretty flat. Hence why you would think that it is cheap, but that doesn't mean it's paying.
Yeah.
It could be like a good return to risk trade, but good luck trading it because you're probably losing money.
Right.
You got to be super.
In some ways, I think it's been insanely fairly priced this past year, right? Like its cash flows are delivering exactly what the hedge offset should do.
Yeah, that's no fun. We don't want to be. We don't want fairly priced. We want unfairly priced. Right.
Both ways.
If you have fairly priced, though, that means the gamma that you're getting is probably cheap because if you're buying options and you have that infinite gain with the limited loss kind of P&L profile, and it's perfectly priced, it's just well priced right now. That kind of, to me, means that the gamma is cheap, even if the option isn't.
Yeah. You know what owning gamma was like for me? It was like coming to Friday and realizing that you're in dry January. That's what it's like. I swear I got 2 days I can't control my gamma, or I can't manage my gamma for Saturday and Sunday. And just, what am I going to do? It was terrible. No, I think though Mark and I probably are on opposite sides of the equation of loving long gamma versus loving short gamma. Would you say that's true, Mark?
You think I'm a short gamma guy?
I thought you were a long gamma guy. I was more of a short gamma guy.
Yeah, okay. I would definitely say my bias was to the long. My firm's bias was to the long too, right? Like, I think in the same way that like a tail risk fund sets itself up, right? That like, keep your carry low enough in all the right places and hope you keep hitting on something moving and, cash in on that down day, the activity from the down day.
Yeah, we like to be more the insurance company and sell premium. So we wanted to sell insurance premium. However, insurance companies don't hedge themselves. They do for catastrophic risks, and we would always do that. So we would end up being a massive butterfly sort of position, or a condor or whatever. It wasn't. We didn't set up and try to do a condor. It was just look like a condor, or look like a butterfly, but massive,
In many ways, I think that's evidence of the two different regimes that we traded in, right? Like VRP in the 90s and early 2000s was considerably higher than it was in the following decade, to the point that it's almost gone negative at this point in 2021, 22. So it was incredibly profitable to be an options seller, right? I mean, Steve Fawcett flew around the world on short options.
He
did. So, I mean, that was a great business to be in for a while.
Yeah. Plus in that era, there was a lot of mispricings and people didn't understand implied volatility as well, I think. So I think the investing public then probably paid way too much for things, and it naturally caused the other side, meaning the market makers, to be predominant sellers, is what it seemed like. So, but look at it as the industry's evolved and the industry's matured. Now we have so many tools like Mr. Volland over here. There's a lot of ways to slice and dice value. So I think it's a good thing. I like it. So.
Speaking of butterflies, though, I think that's one of, from a retail perspective, one of the more interesting things to experiment as a tail risk hedge, right? That like relatively cheap, you can get a decent bang for your buck on long dated butterflies, even with decent width out there. So, if you're worried about like market type crash scenarios, whether it's this month, next month, like that's a cheap way to get, decent convexity on a down move, should they happen. And, your cost of outlay is not going to dampen us if that doesn't happen.
Right. Remember the show we did, Mark, a long time ago? If you knew where a stock was going to close, what option strategy would you put on?
Yes. It's a butterfly, without a doubt. Right?
It's amazingly a butterfly. Right?
I mean, assuming you have limited capital.
Right. Okay, let's address that next time. I'll let you explain next time, and then Jason's gonna tell us why we're wrong. He's an economist, man. He's gonna outsmart us on this. I know it.
If you knew where the market was going to close, butterfly is the only answer. I don't get a different answer.
Well, could it be? Okay, we'll talk about it next time. We're running out of time. Okay. Well, good seeing you guys. Happy New Year. Let's talk a little bit about our market predictions for next time. We'll have another week under our belt. Not that I'm any good at predicting direction, but maybe someone is. And until then, think about me when I'm having a wine glass full of water, watching Yellowstone for the rest of January.
Best of luck to you, Lex.
All right. Talk soon.
Happy